All right, let's dive right into this explainer. Today, we're taking a high-flying market powerhouse, Monster Beverage Corporation, and running it through our ultimate stock analysis, the Guru Gauntlet. We're going to evaluate its fundamentals and, more importantly, its stock price right through the eyes of history's absolute greatest investing legends.
Here is our agenda for today. We'll start with the company snapshot, then look through the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll run some DCF and comparable models, and finally wrap up with our synthesis and final verdict.
Section 1. Company Snapshot. Meet the energy juggernaut.
Let's ground ourselves in exactly what we're analyzing today. Monster Beverage, ticker symbol MNST, is currently trading at roughly $96.55 a share. That gives them a massive market cap of $94 billion. They're a global leader in developing and marketing energy drinks, and they command this intense brand loyalty across a huge portfolio. We're talking their core Monster Energy line, Reign, Bang Energy, the whole shebang.
And honestly, the momentum here is just undeniable. Look at this. In Q1 of 2026, their net sales actually crossed the $2 billion mark for the very first time. They jumped a massive 26.9% year over year to $2.35 billion. International sales alone shot up nearly 45%. Plain and simple, this company is an absolute growth machine.
But with sales exploding like that and the stock trading near all-time highs, we have to ask a really critical question. How does a modern, high-octane momentum stock like Monster hold up against the strictest old-school value investing frameworks in history?
Let's find out in Section 2, the Buffett lens, moats, management, and margins.
So Warren Buffett focuses heavily on economic moats, pristine balance sheets, and financial consistency. And honestly, he would genuinely love these fundamentals. Monster has a massive brand moat with incredibly sticky consumer habits, and their global reach is expanding fast. Their earnings are super consistent too, with Q1 EPS up over 27% to 58 cents. But the best part for Buffett? They literally have zero long-term debt. None. Add in a management team that aggressively buys back stock, repurchasing $100 million worth at an average of $73.86 recently, and you've got the makings of a classic Buffett favorite.
The absolutely crucial metric for Buffett is right here, a staggering 26.65% return on equity. This proves management is highly efficient at compounding capital without using leverage. But, there's always a catch. Buffett demands a margin of safety. While he definitely praised the business quality, that steep entry price of over $96 a share only offers a trailing free cash flow yield of about 2.19%. That's probably going to keep him from buying today. He'd call this a wonderful company for sure, but he's waiting for a fair price.
Let's move on to Section 3, the Lynch lens, growth at a reasonable price.
Peter Lynch loves companies growing incredibly fast. He calls them fast growers, but he absolutely refuses to overpay. To figure that out, he relies heavily on the PEG ratio. That's simply the price-to-earnings ratio divided by the company's growth rate. Ideally, Lynch wanted a PEG ratio below 1.0 to guarantee a margin of safety, meaning the PE perfectly matches the growth rate.
Well, here comes the reality check. Despite Monster's impressive 26.9% top-line growth, their PE is so high that their PEG ratio sits at a lofty 3.59. You are paying a huge premium for every single unit of growth. Under the Lynch lens, this is a glaring red flag. He'd likely hold off entirely until the price drops to a much more reasonable multiple, probably waiting for that PEG to get a lot closer to the 1.0 to 1.5 range.
Next up, Section 4, the Graham lens, the defensive investor's gauntlet.
Benjamin Graham, Warren Buffett's mentor and the godfather of value investing, has an unforgiving defensive checklist, and seeing Monster's high-octane valuation might just give Graham a heart attack. While Monster's massive size and bulletproof balance sheet pass with flying colors, the rest is a really tough sell. Earning stability? Pass. They've got 10-plus years of positive earnings. But Graham demanded a dividend record, which Monster fails because they only do buybacks. And crucially, Graham required moderate valuation metrics, a PE below 15 and a price-to-book below 1.5. Monster's staggering 49.5 PE and 10.8 price-to-book completely fail Graham's strict defensive parameters.
Let's take it a step further. To see exactly how far off we are from old-school value, let's plug Monster's trailing 12-month EPS of $2.06 and its book value per share of $8.92 straight into Graham's famous intrinsic value formula.
Yeah, Graham's formula outputs a fair value of exactly $20.33. That is a massive gap from its current trading price in the mid-90s.
For Benjamin Graham to even look at this stock, we would essentially need an apocalyptic market crash just to hit his required margin of safety. Okay, Section 5, DCF and comparable models. Grounding history with modern math.
So the historical gurus are definitely wary of the price tag. But modern markets are willing to pay premiums for dominant, asset-like growth stories, right? Let's run a standard discounted cash flow sensitivity table. Assuming a very generous 15% free cash flow growth rate going forward, an 8% weighted average cost of capital, and a 3% terminal growth rate, our base case DCF yields a fair value of roughly $50.50 per share. Even if we push our assumptions to the absolute most optimistic bounds, we still only get a valuation of around $75.20. It's still well below the current market price. And when we look at industry comparables, that premium becomes even more obvious. Monster's 49.5 PE completely towers over traditional beverage giants like Coca-Cola at 25.9 and Pepsi at 21.6, and totally eclipses National Beverage at 16.6. Now sure, Monster is growing significantly faster than Coke and Pepsi, which justifies a premium for sure, but investors are currently paying nearly double the industry average for that growth profile. Finally, Section 6, Synthesis and Final Verdict. Bringing it all together.
Let's synthesize all these frameworks. Fundamentally, let's be absolutely clear. Monster is an incredible powerhouse. They are delivering unprecedented Q1 sales growth of nearly 27%. They operate with a flawless, zero-debt balance sheet, generate an unmatched 26.65% return on equity, and their international expansion strategy is a massive success. Objectively, it's a spectacular business. However, the risks here are almost entirely valuation-based. With a near 50 PE and a PEG ratio of 3.59, there's basically zero margin of safety. Plus, management did note some modest supply chain vulnerabilities recently. Specifically, rising aluminum costs created a 1% margin headwind. When a stock is priced this perfectly, any slight misstep in growth or escalating input costs could trigger a severe price correction. Bringing the math together gives us a really clear consensus. Across Graham's strict math at $20, Lynch's growth constraints needing a price under $60, and a standard modern DCF coming in around $50.50, Monster is currently trading at a massive premium to its intrinsic value. At $96.55, the math is incredibly tight. Therefore, our final verdict from the Guru Gauntlet is a hold. Monster Beverage is a fundamentally flawless business that is currently priced for absolute perfection. Savvy investors should absolutely acknowledge the quality of the company, but firmly wait for a wider margin of safety before buying in.
We'll leave you with this provocative thought to wrap up this explainer. A great company isn't always a great stock. Knowing what we know now about the math, what is the specific target price that would make you confidently pull the trigger and add this growth monster to your portfolio? Think about it, run the numbers for yourself, and as always, keep learning.